what he's expecting from Reliance. Deven, hi, good afternoon. Years of tracking Reliance. What do we expect this quarter, though?
Yeah, good afternoon, Aisha. Well, I think the couple of important points. I think this quarter could be, the quarter, where probably we'll see both industrial products as well as the consumer product segments showing up, significantly better performance. Largely the fact that I think they have been having the advantage of lower crude price as far as the tech is concerned should get reflected into the refining and the petrochemical products revenue stream particularly. And that's what I think one is basically expecting to see, higher amount of contribution. Currently, they are about 55-56% of the total profit picture, comes out of the industrial products. And around 40-45%, comes out of the consumer-facing products as a total EBITDA pool of the company. In my viewpoint, I think this time around there is a very strong possibility that I think you're going to see slightly better contribution coming from the industrial segment vis-a-vis the consumer segment per se, because the size of the pool is increasing and the profit margins are going to be better in that area of activity. The retail business, in a way, I think if you look at the FMCG part of the retail business, which has now become the subsidiary of Reliance Industries, is basically growing at a faster pace. Last year, about 11,000 crore. This year, expected to be somewhere around 20,000 crore, March 26, is going to be the pace at which I think the retail business, FMCG business particularly, is growing. And overall pool of, the retail distribution business in the retail particularly is happening because of the GST cut and a higher amount of availability of funds in the hands of consumer. So overall, I think the growth in the volume terms as well as I think in the business overall, I think is going to grow very smartly. The one point which you will probably, I think, and all of us are looking at is Jio Platforms, which is basically coming up with an IPO by the middle of this calendar year. In my viewpoint, I think Jio Platform is the one I think which is going to be the driver of the profit picture as well as the stock. Believe that I think about 65,000 odd crore kind of an EBITDA making machine in Jio Platform could possibly grow at a compounded rate of growth of around 15 to 20% in a larger format in which they are entering, including some global expansion that they are talking about. So overall, both consumer-facing businesses as well as industrial business, I think both of them are likely to show better performance in the third quarter of the financial year.
Okay. Deven, there's also banks, right? And some of the PSU banks have come out with a very decent set of numbers. Today, we had a central bank come out. We also spoke with the Union Bank of India. Again, more than a decent set that some of these banks are delivering. Do you believe that that's where the lower hanging fruit within the financials is? Where is it that risk reward looks most compelling to you?
Harsh, I think the important part out here would be that yes, I think some of the public sector banks and among them I think smaller banks also, they are putting it a valuation which is far more cheaper compared to I think their peers in the mid-tier and the larger segment is concerned, both in NBFC as well as in the bank is concerned. When I look at I think one important differentiator here, of course, I think the advantage is that lower interest cost regime helps in form of bringing down the liability related cost, unless I think the banks have not been able to manage the asset liability part, I think in a systematic manner. But overall, as a direction, I think they are in a better position to bring down the liability side of the cost. Importantly, I think the acceleration, as I see it in the business for stronger NBFC and the stronger private sector bank, would be the integration of the fintech platform in extending the loans to the end customer in a systematic and sustainable manner is going to be the key drivers. For example, Bajaj Finance kind of companies, they are growing between the 22 to 25% CAGR kind of a loan growth. Even their housing finance company also grows in the same fashion, I think around 22%, 23% kind of a growth, loan book growth. Whereas I think the industry players are growing in single digit or maybe slightly higher to a double digit. In my viewpoint, I think the biggest differentiator for them is, I think, the adoption of fintech at the front in distributing the loan. So our eyes remain absolutely focused. They're one who grows systematically, keeping minimum amount of non-performing assets into the book, and at the same time, higher amount of growth rate in tech. I think that they are producing due to use of the technology. is something which we like the most. Of course, liability side management, as I said before, the blessings that interest costs have come down. So obviously, I think you're managing it a little better than what you used to manage last year, for example.
Okay. Deven, the other piece that I'd be keen to know is IT, because that's the other big mover. Again, you're seeing a bit of a divergence, and L&T Tech, the numbers were softer, at least on the top line. Market's super disappointed with regard to that. But then you have Infosys, which has hiked its guidance. Do you believe that there as well, that the risk reward looks most compelling within large cap versus mid, small, ER&D? Where are you placed within that basket?
Undoubtedly, the large caps, largely because of the fact that I think they are probably putting at a valuation where the downside is minimum. The mid-size IT companies have been probably putting at a valuation where probably I think the chances of mistakes are not allowed in the marketplace, or lower expectation growth or lower than expected growth is not allowed in the marketplace. So Infosys, TCS, HCL Tech results have given that kind of indication very clearly. One, in the quarterly order intake rates, I think the order book position that they have created in most of the verticals, I think have been far more better than probably the market was little nervous about. So that is one good point which has happened. Second thing, even if you normalize the profit after deducting that labor cost related thing which has affected all of them, I think at least the worst part is getting booked into the quarter, and I think the next quarter starts with a relatively fresher kind of a outlook. So, in my viewpoint, the large cap companies are having two bigger advantage also along with. One, their clientele size is big, obviously, and as a result of which, I think they're in a better position to win the larger part of contracts. That is the first point. Second, the coding part of the activity through the use of AI, I think has systematically started helping them in delivering the solution faster to the client. And third, likes of TCS have demonstrated that they would like to go for capital intensive business model in form of data center as well. So which is giving them, I think, good amount of product related sustainability related growth, I think, in coming times. So in my viewpoint, I think it makes sense to stay with, I think, the larger ones. Their downside risk, I think, remains limited in this kind of situation.
Deven, great to have you on the show today. Thank you so much for your time.
Thank you. Thank you so much.
Okay, on that note, let's take a very